Regime E 2020-2026. The period after 2020 has been defined by extraordinary events that significantly impacted the global economy. The pandemic caused a sudden halt in economic activity, leading to massive interventions by governments and central banks. At the same time, supply chain disruptions contributed to rising inflation. Geopolitical tensions further increased uncertainty in global markets. This period stands out as one of the most volatile in recent decades and presents major challenges for investors. Bond market impact. The bond market faced significant pressure during this time. At the start of the pandemic, interest rates dropped sharply, which supported bond prices. However, the situation quickly reversed. Rising inflation forced central banks to increase interest rates, leading to a sharp decline in bond prices. The year 2022 became one of the worst years for bonds in modern history. Volatility increased dramatically, surprising many investors who traditionally viewed bonds as stable assets. Gold performance gold once again demonstrated its strength. It reached new record highs, supported by uncertainty and geopolitical risks. Central banks also played a key role by increasing their gold reserves, which further supported prices. Gold continued to act as a hedge during times of crisis, reinforcing its importance in modern portfolios. This period clearly shows that traditional relationships between assets can change, and investors must remain flexible and adapt to evolving market conditions. Real interest rates and gold. The relationship between real interest rates and gold is one of the most important concepts in financial markets. Traditionally, gold is inversely correlated with real interest rates. This means that when real rates decrease, demand for gold tends to increase. The reason is simple. Gold does not generate income, so when real returns on safe assets are low or negative, the opportunity cost of holding gold becomes smaller. In such environments, investors are more willing to allocate capital to gold, which increases its demand and price. For many years, this relationship was considered a reliable rule in investing. Recent changes. In recent years, however, this relationship has started to change. Gold has continued to rise even during periods of relatively high real interest rates. This suggests that other factors are becoming more important. Investors are no longer relying solely on interest rates when making decisions. Geopolitical risks, global uncertainty, and increased demand from central banks have all contributed to this shift. This change highlights the evolving nature of financial markets and shows that traditional models may no longer fully explain asset behavior. Conclusion. The key takeaway is that real interest rates still matter, but they are no longer the only driver of gold prices. Geopolitics and broader economic uncertainty now play a significant role. For investors, this means adopting a more comprehensive approach and considering multiple factors when making decisions. Understanding these dynamics is essential for navigating modern financial markets. Long-term data insights. Long-term data provides valuable insight into how different assets behave over time. Gold has delivered strong returns, but with higher volatility. This means that while it can generate significant gains, it also comes with greater risk. Bonds, on the other hand, benefited for decades from falling interest rates, which supported stable and predictable returns. However, the year 2022 challenged the perception of bonds as completely safe assets, as investors experienced notable losses. Correlation patterns. Gold has an important characteristic. It is often uncorrelated with stock markets. This makes it valuable for diversification. It also tends to have a low correlation with real interest rates, although this relationship has shown changes in recent years. Recent deviations from traditional patterns indicate that markets are becoming more complex. Market evolution. Modern financial markets have evolved significantly. Central banks now play a larger role in driving demand for gold. As a result, traditional models that once worked well are no longer always reliable. Investors must adapt to this changing environment by considering a broader range of factors. Flexibility and awareness are now essential for successful investing. When bonds outperform, bonds perform best under specific economic conditions. One key scenario is when interest rates are high or declining. When rates fall, bond prices rise, generating capital gains. Bonds also perform well in stable, low inflation environments. In such conditions, their fixed income maintains its real value. Another important factor is income from coupons. Bonds provide a steady stream of payments, which is especially attractive for investors seeking stability. When gold outperforms, gold performs best in very different conditions. It tends to outperform when real interest rates are low or negative. It also excels during periods of high inflation when investors seek to preserve purchasing power. In addition, gold becomes particularly valuable during systemic or geopolitical crises. In times of uncertainty, demand for gold typically increases. Strategic insight. The key strategic insight is that different economic regimes favor different assets. There is no permanent winner. This is why diversification is essential. Combining gold and bonds can reduce risk and improve portfolio stability. Understanding when each asset performs best allows investors to make more informed decisions. Portfolio strategy. Both gold and bonds play important roles in portfolio construction. Bonds provide income and liquidity, offering stability and predictable cash flow. Gold, on the other hand, acts as protection during periods of crisis. It often maintains or increases its value when other assets decline. Combining these two assets can significantly improve portfolio resilience across different market conditions. Modern considerations. In today's world, gold is increasingly influenced by geopolitical factors. Central bank actions, global conflicts, and economic uncertainty all impact its price. Bonds, meanwhile, are strongly affected by inflation expectations and monetary policy decisions. Financial markets are more dynamic than ever, requiring investors to continuously monitor conditions and adjust their strategies. Final takeaway. The final message is clear. No single asset consistently outperforms. Performance depends on the economic regime. Investors must understand the broader context rather than rely on one factor. A balanced portfolio that includes multiple asset types offers the best long-term stability. This balance helps reduce risk and prepares investors for unexpected changes in the market.